The Fed just paused rates at 3.5%, but you could still be overpaying $4,000 a year on debt. Credit cards at 24%, car loans at 14%. Check your statement right now because most people are missing this. The Federal Reserve just paused rates at 3.5 to 3.75%. After multiple cuts through 2025, things finally slowed down. And when that news hit, people reacted fast. Social media lit up, headlines pushed the same idea everywhere. Borrowing just got cheaper. It felt like relief was here. It felt like things were finally turning in favor of regular people. But here's what actually happened in the real world. Credit card bills didn't change. Car payments stayed exactly the same. Student loan interest didn't suddenly drop. For most people, nothing in their day-to-day financial life actually improved. That gap between expectation and reality is where the problem starts. Because the Fed pausing rates sounds like something that should help you directly. It sounds like your costs should go down automatically, but that's not how the system works. And if you don't understand this part, you'll keep overpaying without even realizing it. If you've ever looked at your credit card statement and felt stuck, you already know this feeling. You've got a balance sitting there, maybe $8,000, maybe more. Your APR is somewhere in the 20+% range. You make payments every month, sometimes even more than the minimum, but the balance barely moves. It feels like you're running in place financially. And when you hear that the Fed is cutting rates, you naturally expect things to get easier. You assume those changes will show up in your account, but they don't. And that's not because something is broken, it's because that's exactly how the system is designed. Here's the key idea you need to understand. The Federal Reserve does not directly control your borrowing rates. It doesn't set your credit card interest. It doesn't adjust your car loan. It doesn't lower your mortgage automatically. What it actually controls is the overnight lending rate the rate banks charge each other for very short-term loans. Everything else is decided by the banks. Your credit card rate, your auto loan rate, your mortgage, all of that is based on how banks choose to price risk and profit. And they don't move those rates equally in both directions. We've already seen how this plays out. In 2022, the Fed raised rates aggressively more than 400 basis points in less than a year. Credit card APRs reacted almost immediately. Rates jumped from around 16% to over 20%, then 22%, then even 24%. Banks moved fast when it increased their margins. Now look at what happened after that. The Fed started cutting rates again. Since late 2024, we've seen meaningful cuts. But credit card APRs didn't drop at the same speed. They're still sitting around 22 to 24% for many borrowers. That's the reality. Rates go up like a rocket and come down like a feather. And that difference is costing people thousands of dollars every single year. So let's break this down clearly. Where exactly are people overpaying right now? And how much is it actually costing? Start with credit cards. This is the biggest one for most people. Average APR in the U.S. is currently between 22 and 24%. If you're carrying a $10,000 balance at 23%, you're paying about $2,300 per year in interest alone. That's not reducing your debt, that's just the cost of carrying it. And here's what a lot of people don't realize. There are options available right now to reduce that cost significantly. 0% intro APR balance transfer cards are still widely available. Many of them offer between 15 to 21 months of zero interest. That gives you a window where every payment goes toward your principal instead of interest. If you use that time properly, you can save thousands. The opportunity is already there, but most people don't act on it because they assume the system has already adjusted for them. They assume the rates they're seeing are normal or unavoidable, and that assumption is exactly what keeps them stuck. Now look at car loans. This one flies under the radar for a lot of people. The average used car loan rate right now is around 11.5%. But if you financed a vehicle in 2022 or 2023, there's a good chance your rate is much higher, 13, 14, even 15%. At the same time, credit unions and lenders are currently offering rates closer to 7 to 8% for qualified borrowers. That gap matters. On a $25,000 loan, the difference between 14% and 7.5% is more than $1,600 per year. And refinancing a car loan is not complicated. In many cases, it can be done online in under 20 minutes. But again, most people never check. They assume once a loan is set, it stays that way. And that assumption ends up costing them money every single month. Private student loans are another area where people are quietly overpaying. Federal loans are fixed, so those don't change, but private loans are different. If you took one out in 2022 or 2023 at 9, 10, or even 12%, you may have better options today. Some lenders are currently offering refinance rates closer to the mid 4% range for qualified borrowers. On a $50,000 loan, dropping from 10% to around 4.5% can save you more than $2,700 per year. Over time, that adds up to tens of thousands of dollars. And timing matters here. These opportunities don't stay open forever. If inflation rises again or the economy shifts, those lower rates can disappear just as quickly as they showed up. Then there are mortgages. This is where the numbers get even bigger. Many people locked in rates around 7.5 to 8% over the past couple of years. Right now, rates have pulled back into the mid 6% range, and projections suggest they could move closer to the high 5% range by 2026. On a $400,000 mortgage, even a 1% drop in rate can mean around $300 saved every single month. That's $3,600 per year. Over the life of the loan, that can add up to over $100,000 in total interest savings. The refinance window for mortgages isn't fully open yet for everyone, but it's close enough that you should already be paying attention. Because when that window fully opens, a lot of people will rush in at the same time, and the best opportunities won't last long. So here's something practical you can do right now. A simple 5-minute check that can tell you if you're overpaying. First, list out all your current interest rates. Credit cards, auto loans, student loans, mortgage, write them down somewhere simple, even in your phone. Second, compare those rates to current averages. Sites like NerdWallet, Bankrate, and Credible update this data regularly and make it easy to check. Third, look for the gap. If your rate is more than 1 percentage point higher than what's currently available for your profile, there's a strong chance you're overpaying. And that gap adds up quickly. 1% on $30,000 is $300 per year. On $80,000 of combined debt, that's $800 per year. That's money leaving your pocket quietly every single year without you even noticing it. Now here's where behavior really starts to matter. Most people are in waiting mode right now. They're watching the Fed. They're waiting for the next rate cut. They're hoping conditions get even better before they take action. But while they wait, nothing improves. They keep paying high interest on credit cards. They keep paying elevated rates on car loans. They keep losing money month after month, just more slowly than before. The people who actually make progress in this environment think differently. They don't wait for perfect conditions. They act when the math already makes sense. They treat this rate pause as a window, not a waiting room. A window where they can reduce high interest debt, refinance where it makes sense, and improve their financial position before the next shift happens. They focus on what they can control, paying down expensive debt, locking in better rates where possible, and using current savings rates to earn on cash while reducing costs on the other side. That combination, reducing what you pay while increasing what you earn, is what creates real financial momentum over time. And here's something most people don't realize. The best opportunities don't show up after rate cuts. They show up just before or during transitions like this. Once the market fully adjusts, lenders update their offers. The best deals start to disappear. Competition changes, and the advantage shifts away from the borrower. The people who act early lock in better outcomes. The people who wait for certainty usually end up paying more for it. So the 3.5% Fed rate isn't a solution handed to you. It's a condition, a moment in time where you have the chance to act differently. What you do in this window determines whether you keep overpaying or start taking control of your financial situation. So here's what I want you to do right now. Pause for a second, pull up one debt, just one. Look at the rate, compare it, and decide if it still makes sense to keep it as it is. Don't wait for the next rate cut, fix one debt today. That's where real savings begin. If this made you think, check your numbers. That's where real financial decisions happen, not headlines. If this helped, drop your rate in the comments, hit like, and subscribe for more no fluff content. I'll see you in the next one.